Hey, what's up, guys? It's Tyler here from Fallible, and today I got a special treat for you guys. I am in the office of Alex Barrow, our lead macro analyst here at Macro Ops, and we're going to be talking about 2020 recession and also what he thinks about is going to happen in the market in the coming month. But before I do that, guys, I want you to quickly go down to the description and click that link for the Macro Ops Collective. It's a macro program that we're opening up for fall enrollment. This is our flagship product, and Alex is actually the main dude that writes all the analysis for this product, and you're getting able to join a awesome community of traders. You're going to get macro research every day. We also have value research coming out every month. It's our absolute best product, the one we've been running since we started Macro Ops. So if you're interested in something like that and you guys want to join an awesome community of traders, make sure to click that link in the description and check that out. So here is the man, the myth, the legend, Alex Barrow.
Hey guys, how you doing? Good to be here.
Yeah, so I want to first ask you about the 2020 recession, because I've seen a ton of videos on YouTube talking about some pending 2020 recession, and a lot of those guys are people that want to see the economy recess so Trump doesn't get elected again, which I kind of find a little funny. But what's the objective viewpoint here on 2020? Are we going to actually get a recession?
I'm not sure that there's been any point in history where everybody on YouTube or collectively has predicted a recession and then it's happened. So I'm going to go with no. The fact that we're making this video makes it very low odds that we're actually going to see one next year.
All right, so yeah, I think that's a good point. You're basically saying that since so many people are making videos about a recession, it's not going to happen because recessions happen when people least expect it, right?
Right, yeah. Recessions happen from over leveraging, which is due to over optimism in the economy. People extending themselves financially, taking out bets when they shouldn't be doing it. That's obviously not happening right now because everybody's calling for a recession. So, yeah, I would say fade the masses.
All right, cool. And then do you have any charts or data that you're looking at? I know you've been sending some stuff out to the collective guys. Can you show these guys a little bit of what exactly you're looking at?
Yeah, let's hop through. I'll show you guys some of my main charts.
Wait, first off, what is this that you're using here? What is this program? This is interesting.
So I run two main programs that we use. This is the Reuters Icon Terminal. It's actually been bought out by Refinitiv, so now known as the Refinitiv Terminal. And then we have over here the fancy Bloomberg terminal, which you can see on the keyboard right there.
Oh, nice! Yeah,
everybody knows what that is.
That's a new keyboard I haven't seen you have. Yeah, that's the quintessential Wall Street keyboard. So, All right, so you got all the big league software here and all the data. So how do you use this and what are you looking at here?
All right. So let's just run through some basic charts, right? So what is a recession? It's a slowing of the economy that kicks off kind of a positive feedback loop with negative consequences. So one of those consequences is a reversal in the labor force growth. So you see people starting getting laid off, right? So this is a pretty standard recession indicator. It's just the unemployment rate moving average crossover. We use 12 and 36, which your 12 is the green line right here, 36 month is the red line. Well, you can see right here, we just hit 3.5, which is one of the lowest readings in decades. And just looking back at the past three recessions, you can see, back here in 1990, before the recession, we saw the unemployment rate jump above both the 12 and 36 moving average. Again, here in December of 2000, right as the bear market was kicking off, and then again, here it crossed over in August 2007, gave us a good lead before the bear market started. So according to this indicator, there is no recession on the horizon yet.
All right, what else do we got? Is there anything else that you're looking at?
Yeah, there's a bunch of other ones. So here's another one, Kansas City Fed labor market conditions. It's just another way of measuring the activity in the labor market and the strength in the labor market. I mean, you see in the last two recessions, that clearly turned over. We recently made a new high in the reading back in July. So things are looking pretty good there. Temporary jobs payrolls with the 12-month moving average, that's the blue line right here. So temp jobs are usually the first to go when things start slowing down. That's why this is a decent leading indicator. You saw it cross over here in November 2000. Again, here in March 2007, if you guys remember, the market peaked in October of 2007. We briefly dipped under that moving average in July of 2019, but we popped back above it last month, so all is good there. Here's another one that I really like. This is the Philadelphia Fed Coincident State Index. It's a 1 month diffusion index, and this kind of looks at the underlying activity on a state-by-state level. and it can show like how different states are doing. So we've seen weakening in this one. This is something that we need to watch. Back in July, it made a new low, but then we've also seen it bounce back a little bit in August. Usually when you see it fall below the 50 level, it's not guaranteed that you're going to be in recession, but you really want to be on alert. A lot of this current weakness is likely due to the trade war because we're seeing a big divergence between state by states and economic activity.
Cool.
All right. Let's hop in some other ones. All right, so here's just like, these are the key ones that I look at. This is really all you need if you're going to be trying to predict a recession, which you shouldn't spend too much time trying to do anyways. On the top left, we have that leading economic index from the Conference Board on a nominal basis and a year-over-year basis. So this typically leads recession by 12 months. When you see this thing turn negative, it's still positive on a nominal basis. It made a recent new cycle high just the other month, and it's positive on a year-over-year basis, so no problems there. Another one is inflation-adjusted real retail sales. Consumer spending is what drives the underlying economy. We saw this dip in December, likely on the back of growing fears from the market sell-off and consumers pulling back a little bit. Well, we've seen it trending up since, and in August it's back up to almost 2.4%, which is a pretty decent growth. You can see preceding the last two recessions, it turned negative right as the market was peaking. In 2007, it turned negative well before the market peaked. Bottom left, temporary help payrolls. This is kind of like our other temp job payrolls. It's just another way of looking at it. Here it is on a year-over-year basis. You can see, we'll see temps start bleeding off well before a recession starts. We saw a little dip earlier in the year, but things have bounced back and growth is positive. And lastly, we have liquidity. This is the Chicago A&F CI index. It's just a way of gauging financial stress in the economy. So when this thing, I have it inverted here, when it turns positive like this, like we saw in 2007 and then again in 2000, that's when there's stress entering the system. That's when you want to become a little bit more defensive. Right now, there's nothing to worry about. Another really good liquidity indicator that we like is Kansas Fed Financial Stress Index. You can see back here in 98, things started trending up. That preceded the bear market. Again, in mid-2000, this thing just started rocketing higher well before the market started peaking. That preceded a recession. Where are we right now?
Nothing looks like.
Yeah, well, we're just going along sideways, so that's good. Conference Board Employment Trends Index, again, another labor indicator on a nominal and year-over-year basis. We just recently made new cycle highs. There's that indicator that I shared earlier. And then this is just growth and initial jobless claims.
So what does this mean, though, initial jobless claims?
So that's just, it's kind of another way of looking at employment, right? So when you see people start getting laid off, they make claims for unemployment with the government. That's what this is. This is just looking at it on a growth basis, smooth to kind of pull out the noise. And you can see this thing spikes going into every recession. Right now, we're still negative. Boom. Really nothing to worry about. And then lastly, new housing starts. This is another very solid, high fidelity recession indicator. This thing usually leads the market or really the economy by 20 to 24 months. The reason being because housing is a big purchase for consumers. Building homes drives the economy. So look at this thing. Like I said, it usually leads the greater economy by about 20 to 24 months. We just made a new cycle high in this last August.
So housing's crushing it right now.
Yeah, housing is crushing it, and the reason why is because interest rates have been falling. We're almost back near cycle lows. Mortgage rates have been dropping, so people are taking out money to buy homes. That's pretty simple.
Nice. Well, yeah, thanks for that update, Alex, on 2020 Recession Watch. I think that was a really interesting take that I haven't really seen a lot on YouTube yet. Now, like another thing I wanted to ask you about is the coming months in the markets, because everyone's kind of starting to notice a little bit of volatility. We've had these over 1% down days, and it's getting a little bit scary out there. So what do you think in the next month? Like, what's happening?
Yeah, so we've been defensive for the last 2 weeks. We saw the sell-off coming. I think it's going to extend for probably another 10% or so. We're in the next 2 weeks tend to be the weakest of the year seasonally, so expect a lot of volatility. We have trade talks coming up this weekend, which aren't looking good. So I expect a lot of bad narratives to come out around that. And then furthermore, sentiment has broadly depressed, but it's not at extremes. And we've been in a trading range for the better part of a year and a half. And so what you need for like a new trend to start is you need a local extreme in sentiment and technicals. And that's going to like kickstart a trend in the other direction. So what I'm looking for is kind of a giant bear trap sometime over the next couple weeks, sell off in the 10% range, maybe a little bit more. And then that's going to kind of set the stage. You're going to sell out, wash out all the weak hands, and then we're going to rock it. Seasonally, we usually tend to bottom on average around October 26th. I mean, you never want to be that precise, but I'm looking maybe around November. We're seeing a lot of positive signs of some stabilizing out of China, even though things are still slowing down a little bit there, but they're not slowing down as much. And if we start to see a little bit more weak numbers and we start to see volatility like really increase over the next 2 weeks, it's going to raise the odds of the Fed cutting rates again at the end of this month. So you're seeing a lot of things set up. Expectations around earnings have come down a lot. So I think the consensus expectations for something like around 3.5% negative earnings per share growth this quarter. So that's a pretty low hurdle for stocks to clear. So that's what I'm looking for. I'm looking for a bear trap on a sell-off and then kind of a rocket higher because there's a lot of people under position for an upward move.
All right. Well, thanks, Alex, for taking time out of your day to update us on recession and also where you think the market's going. Guys, if you like this, please hit like on the video, hit subscribe. We'll be doing more of these videos in the future. And also make sure to go in that description and check out the Macro Ops Collective, because that's where you get to hear from this guy right here each and every week, each and every day. I mean, you basically have direct access to him through our chat room in the Slack workspace that we have. You get weekly reports, you get monthly reports from our other analysts, and we also have some really interesting education going on in the collective. So it's a full encompassing product. You get all of the research, you get the community, and you get the education. I believe, Alex, you're building something new for the collective as well. It's an FX course, right?
Yeah, I'm just putting the finishing touches on right now. FX is one of my favorite products to trade. So if you guys like trading currencies, I'm going to be covering everything from kind of soup to nuts on how to trade FX and get like real into the advanced stuff, because the majority of FX courses I've seen out there, they just talk about technicals, which are important, but they're definitely not everything that goes into uncovering large moves in the FX market. So we're going to be getting into interest rate differentials, risk reversals, how to look at sentiment around FX pairs, that kind of stuff. So I'm really excited about it.
Awesome. And yeah, if you guys are collective members, then you get first access to all of that stuff. Those guys always get it fresh off the press. So that's all I got for this video today, guys. I hope you liked it, and I'll see you in the next video.